Let's talk about inflation. So in this chart, we have a United States Consumer Price Index for the last 70 years, from 1951 to until today. In the next one, we have the US 10-year Treasury bill, the yield, for the last, similarly from 1950, an unemployment rate in the blue, and finally the Fed fund, which is the current Fed interest rate. That tells you, like, on a given day, what was the interest rate that Fed had imposed through its monetary policy. Now, this pink line, that the angles here represents the slope of the inflation. So remember, this inflation is not year over year, but the total cumulative inflation as a function of time. So it went from 4 degree in between 1950 when it first started getting recorded. Actually, it got recorded much before, from I believe in from 1870s, but the BLS, the Labor Service Department, Bureau of Labor Service, they have this record that was available to these different platforms from 1950s, but we have a different way of finding it from even before. For this video, we will just consider from 1950s, and then it actually went from 4 degree slope, as you can see, in 1970s during the Vietnam War. Inflation rose to 27-degree angle over here. You can see that for 4 degree to 27 degree must have been painful, and then again it actually sharply rose to 47 degree. During this time, the 10-year, so if you take a sharp line here, if I go and put a vertical right around this time, 1972 to here, 1978. During this time, the slope was 27 degree. So I'm just going to color it differently, maybe magenta. So this timeline, that was about 73 bars, or 2021 days, 2221 days. That's around 1972 to 1978, 6 years, and a little over 6 years. And the 10-year stays between 3.51, you can see on the right in the orange, around this timeline, to 8.6, 8.5. The Fed fund, the Fed started raising the interest rate about 1 year. So if inflation, you can consider, started around 72, you can see the Fed didn't start raising interest rate from 73, before 73, so about 1 year later. And they sharply rose interest rate from, on the right side, you can say 4.78 to here 9.22. So within between 1973 and 1975, within 2 years, in raising interest rate to 500 basis point, close to 500 basis point, 4.64 or 400, I'd say 400 basis point. It's quite a bit in 2 years. And now you'll see that it was much higher now. So in 2019, you can see the Fed fund was 3.2. Oh, I'm looking at the wrong one, sorry. This one, actually, I should look at Fed funds. This is the unemployment rate. So back in here, so my bad, it's actually around this timeline. So okay, start over again. So 1972, the inflation started rising. At the bottom one, the yellow line is a Fed fund. So they actually did started raising the interest rate from 1972, just around the time when the inflation looks like it started. And then they kept raising the interest rate until here. They slowly, like, for a while, they paused or maybe cut the interest rate in 73. So between 71 and 73, 2 years, they raised interest rate from 3.27 all the way to 10.33. So that's 700 basis point close to. And then they cut interest rate a little bit over here to 9.19. So about 100 basis point more than that. And then what happened? You can see that this is the unemployment rate. So as the unemployment rate started rising, right, between this line 73 and 74, so it went from 6.33 from 4.6% ish, right? So you can see on the right side, the number shows up around this horizontal line. So here, when the Fed started raising interest rate, it was around here, right? And at 5.13 unemployment rate. Well, you can say that even before that it was even below 4.99. And then it went as Fed at the bottom. You can see that at the trough at the bottom, the yellow chart, when the Feds cut the interest rate back in around 74, the unemployment rate was rising to 5.13, and then they had to again raise interest rate. Why? Because you can see that the inflation was going up, keeping up. So they had to raise interest rate further. That caused the unemployment rate to raise even further. So this line, so from here 5.41 all the way to here 9.07. So the unemployment rate rose by 400 basis points during this time when the Fed was raising the interest rate. That would cause the Fed to dramatically stop raising interest rate from 12.72% Fed fund all the way to 4%. So they had to cut around 800 basis points. That helped the unemployment rate to 5.69, around 79. But look at the inflation curve. It actually picked up from 27-degree angle all the way to 47-degree angle. And that would be like things going out of control. So Fed is doing whatever they're doing, but it's not working. So then the Fed decided, okay, we don't care. We're going to keep raising the interest rate, no matter what. So here, that was the basically, I think that was basically Volcker probably would have said, I don't know exactly, but enough is enough. We need to raise the interest rate more. And that was probably the 1980s Volcker's, the narrative that's get quoted a lot of times, and even Powell quoted that. So in 1980, Volcker said, we are going to be agnostic about the unemployment rate and we're going to keep raising interest rates. So what happened? From 9.5, the raise the Fed fund here, out of the chart, 18%. That's crazy. The 10-year rose from, in 1980, from here on the right side, you can see 9.5 to all the way to, again, 15%. And the inflation was going up, but then it started reduce, it's 47-degree angle. Now it came down to 30-degree angle. So the Fed would declare a victory here, and they'll start cutting interest rate from there onwards. So here, around this time, the inflation started to curb. So they would start from 18, you can see on the right side, 17.8, 18 to all the way down. They would have to raise interest rate again a little bit, looks like, from 12 to 14, 16. And then finally at 1883, firmly looks like interest rate was going down now to 30-degree angle. And then all the 30-degree is actually higher than 27-degree angle here. But Fed probably would have said that, that's it pretty much, because here 10-year is not something that Fed would really care about. However, the unemployment rate around 1980, it actually dropped to, during this time. So as unemployment rate was dropping, Fed did not have to raise interest rate anymore, because they saw that unlike the previous time where the inflation slope was going up, here after this crazy interest rate hike to 18%, now it was sloping down. Looks like they had to again raise it one time more around 1982, but then that's pretty much it. Then things got under control. And I would like to think that also China had a big role to play here, because around this time, if you remember, 1970s, late 1970s, the China transformation started to happen. It became the new factory for the world, and that would have been a deflationary effect on the overall world. So it's not clear that if that was the interest rate alone would have caused the inflation to curb down, or whether China had a play in it. A lot of things getting outsourced over there with a cheaper cost, even cheaper, much cheaper than today. That China, the Chinese economy would, the cost of the China economy to outsource anything, that probably would have been 100 times cheaper. But that might have an effect in this. Now, if you look at it, since then, until since 2020 till the COVID, so we have this amazing 30-degree constant inflation angle slope. So we have this 4-degree all the way to 27-degree, then we do 47-degree Fed with interest rate hike, and maybe with also the China globalization both together, and unemployment coming down again, unemployment rate. So all things kind of falling together. So we had a good time until 2007. There's no recession, big recession, I'd say. 2001 was a recession actually, but you can say that in around 2000, the Fed fund was 3.93. There's a bit of inflation. You can see the Fed started interest rate again to 6.3. So from 3.79, oops, what I'm looking at here, actually should be around 1998. So this is the Fed fund. So this is 4.2 to 6.18. So 200 basis point almost hike in the interest rate. And unemployment went up as well from 3.86%, which is pretty good, to during this time to here, which is around 5.5%. Obviously, Fed would freak out and they would reduce interest rate. They did, and that was actually causing the recession, right? 2003 recession was shallow, they call it, but there was a recession, the tech recession for sure. And then this interest rate went down to, so look at the Fed fund, it's 0.88. When was the last time it was like this? In 1962. So after, during this time, the Fed fund was pretty high. The 10-year from 1971, when the Fed started raising the interest rate right here, was about 5.7. It never came down below that, 5.6, 5.6. Now, after this Fed, here, look at this area, it started reducing the interest rate. Unemployment went down, 10-year went down, inflation remained constant. So that was a story around then. Then what happened? Then 2020 happened, and we have this slope around 71 degree. And look at the Fed fund here. The Fed fund was about 0.15 here, and now it is 4.51. The Fed fund 4.35, I believe, today. So so within this period of within 1 year, so around 2022 January, I think it was like 0. Fed fund was around 0, I believe, and or 0.15. So within 1 year, it moved 400 basis point. It never happened this pace before. I mean, 0 to 4. I guess it has happened in the past here, even 80 and 81, 80 at 9.29. If you consider 81 right here, 18. So they in 1 year they raised 900 basis point. That was unprecedented, but the percentage wise, it was 100% from 9% to 18%. Here, percentage wise, is 400% from close to 0% to 400 to 4%, 4.35%. So percentage wise is much higher. So almost double the percentage wise increase in a same period of time. So that's why people keep referring to that. Fed has never raised interest rate in this rate before. So this is in this regard. So we have the 71 degrees is the steepest of the inflation that happened during this 28 bars or 850 days. And then we started seeing there's a bit of deflationary effect, right? As you see, the inflation, the CPI year over year went down from 10% to 9% to 8%, so on. In October, it was around 9%, and now today it's 6.5% as of February. So obviously it's going down, but what's the angle, Right now, if you look at the angle, it went up to 71 degree, and now with the same reference point of resistance reference point, we have about 40 degree angle, which is still higher than the initial 27 degree angle in 1970s in the beginning, but lower than the later phase of the 1970s inflation, where it's 47 degree angle. So inflation is still there. The question is how long it will be there. Now we can play around with it. We can see that if you want to go back to this 30 degree angle line, so what does it mean? You need to intersect in this line at some point, so it has to really come down really fast. And the question is that what angle it will come down, right? That will determine that when this inflation is going to is going to end. Now my guess is we're going to never see coming back to this line. Why? Because if you consider what happened here, we're around in 1969, before the inflation started, before the Vietnam War, it was 4 degree angle, right? And where did it end up? 30 degree angle. So almost 7 times more than 7 times, right? So obviously you cannot say that this is deflationary. It's obviously deflationary compared to what happened in 2 years ago in 1980s versus 1982. So 1980s it was steeping at 47 degree, it went down to 30 degree. So there's a 15 degree reduction, or almost you can say around 33% reduction in the inflation. Now if you consider the 40 degree angle, so you consider 33 degree, 1/3 of the reduction in this. So we should see here we're seeing this is around 71 degree angle, and 71 degree to, let's consider from there 1/3 of the 73rd is about 25, so let's say 50 degree angle. So let's say we are around 40 degrees, so we're going to continue in that path. So if we want to add the trend line in this path at 40 degree angle, which is in this line, right? This is the 40 degree, this is the slope of this. Where does it end? Well, this is the new line, right? So this is the new 5% inflation, is a new inflation rate. That's what it tells you, right? Now I'm going to change it a little bit again so that it can be seen better. It will mess up this a little bit, but I think it's okay. So the angle would change a little bit, but here we go. All right, so let's call it 28 degree. Okay, so this is our current trajectory, or rather pre-2021, 2022, pre-2020, the pre-COVID trajectory, before everything changed, for the supply chain and all the other things that kind of combined together was a big cocktail. Now we are here. So if you want to go back to this level, so you want to change from this angle, which is a 40 degree angle, to back to this line. So we have to go back around minus 152 degree, which is all the way here. So quite a bit, actually quite a bit. So almost about, consider this. This shows the angle compared to this. So right now we are here at 40 degree angle, and we have to come down to here. It's 20 degree angle, so 20 degree more. So 20 degree more means out of 71, so you have to reduce the inflation quite a bit. So that means almost reduce the inflation by 70% instead of 20%, right? So you have to do it like almost quite a bit. So from 70 here, we went down to 40. So 30 out of 70, which is about, let's say around, 40%. But here you have to go back to all the way to this level, which is 15 degree. So 71 minus 15, which is 66, right? So 66 degree reduction, which is which is quite a bit, which is 16-degree reduction, which is basically almost 80% reduction. So that basically means that you have a deep recession. Now, if you do not have a deep recession, then you can consider that we're going to have a new trajectory, and the new trajectory is going to look like this, right, in this angle. So when does it meet there? It meets here with the same line around 2034, 10 years, 11 years from now. Or we say that, okay, we're never going to meet the new line, so this is the new angle. So basically we are going to continue like this forever, right? So this new angle, although there'll be a little bit of relief from the inflation, but we are not going to see the same trajectory, right? This is going to be new normal. So we're going to go see, this is going to be the new line of record. Now, if that happens, what is going to be the corresponding Fed employment rate? So now we can kind of do another math. So let's say we want to calculate the angle.
Are you making a video?
We're going to calculate the angle here. Where is the angle go? For 1 second. I think here. So trend angle here, we consider this is what 24 degree, right? So that's a 74 minus 24, which is around let's say around 50. 71 minus 50, 30, 24, around 45 degree. Okay, 45 degree reduction. So here we went from 27 to 47, and 27 to 47, 20 degree reduction. So we have to do almost twice the size, right? From 71 to 25, if you want to go this path for longer, and that is as a function of the interest rate. So two way we can consider it. What is the unemployment level needed to do this, to this kind of transition? If we are assuming that we're in 1970s economy, and what is the corresponding Fed fund rate would be. So if we consider here 20% reduction, 20 degree angle reduction, it required Fed fund to go from 9.7 to about 17, so around 800 basis point. So we are right now at the 4, so we might have to go another this much basis point over here. Now if we do 25 basis point at a time, and right now we are at 4.51, so to go to 8, you need at least 8 more hikes. So that is going to be 8 more hikes every month if you consider this one more year. So in 2024 we are going to be at 1 year from now, maybe we're going to be at 8 over here if they have to keep raising, right? That's where we're going to be. Okay, 1 second, let's see. Okay, so you're going to be at 8, we're going to be there around 28, 24, so 8 hikes. Let's give a tag around 25. So if you meet here, right, so what is the unemployment rate is going to look like? So unemployment rate during this time, when it went from 9 to 18, or around, let's say 900 basis point, the unemployment rate went from here 5.69 to 10.69, so about 500 basis point. So right now we are here, all-time low. So we're going to be here, so we're going to be around this time. If considered the same, we're going to be over here, so very close to where we are around 2008, 2009. So that's why everybody is talking about that. We are going to see the unemployment rate hike, because that's what exactly happened in 1970s. Do you think that we're going to continue to raise this, and the Fed will raise interest rate if the unemployment goes this high into the 2024? Remember, there is a there is this election that is going to be fought throughout 2024, and if you think that it's a sane country and Fed is not going to be raising interest rate during this time, then you can consider that this slope is not going to go back to this 40-degree angle anymore. It's going to be similar to what happened in the past, where Fed actually did reduce interest rate or cause pause, and that would be around this zone, right? So let's say around 1974, right around this, the Nixon and all this episode, to around, let's say here, let's call it here 8.56. So we had a unemployment rate around this 1975 was here at 5.91, went up to 8.93, and Fed, and then we have this inflation went up this angle 27. So if we consider that, and if you think that we are not going to do much, and so it's going to be actually parallel angle like this, so that means everything stays higher, and everything stays higher, and interest rate remains constant. What happens? Let's go back to the 1970s again. So the inflation remained higher. Let's consider it is staying higher at 27-degree angle, and let's focus on this. Let's remove this middle one, and let's focus on this timeline. What exactly happened during this timeline? Okay, between 72 and 78. Let's consider that is our point. So, and the interest rate, if it remains same during this period, then we're going to be in this situation here, where we have to raise from 8.7 to this. So after 2025, I think this, what might happen is that nobody wants to be the president in 2025, because they would say that whoever comes in, they're going to have the most difficult task in the last 100 years of presidency, and that's the reality. So this is hopefully this video was helpful to kind of get a context of what was the case in 1970s. I mean, nobody can predict the future, but that kind of tells you the slope and what the difficulty that lies ahead of us, in context of the past in 1970. And obviously China played a big part for the deflation, and if we consider that China is going to be anti-US in a way that pro-Russia, and we're going to see more globalization, that's kind of a rolling back what we saw that helped US to diffuse inflation in 1982. It's going to be like rolling back from 1982 to back to 1970, and during this time we had this this high inflation rate. I think it's going to be probably might be similar. It might pick up again if we do see China actually isolated or become their own entity, and US China trade relationship worsens. That would not be good for the inflation. And the only hope we have to actually get back to this 45-degree angle, similar to something which happened in 2008, 2009, which is much smaller period of time, is that China come back fully loaded, and supply chain issue completely resolved, and the interest rate remains high. Then maybe we might have a chance to get back to this line, or maybe half of this slope by here. If you consider that here is now new normal, let's say, and then maybe around 2025, 26, we might get some relief. But if we escalate, if US escalates what's happening with China right now, there is no reason to believe that what happened in 1982, without that being our tailwind, we're going to be, there's no reason to believe that we're going to be defeating the inflation. And if that happens, so what that means, that the dollar becomes cheaper, and that means that your house price goes even higher, the salary goes higher, but the house price goes higher, so nobody can afford it. and our savings kind of gets destroyed, and our 5%, 6% of the bond is bond interest is not enough, because as people actually took arm, or their house price although goes up quite a bit, but at some point, if the economy breaks because of this high inflation is non-sustainable, people cannot buy stuffs, and people only go for the lower end stuffs because most of the people cannot buy the expensive stuff. So then everything falls. The house of cards falls, and the repercussion could be many things. So, but this is where it's headed, it looks like. And the solution is, technology solution is globalization. And it seems that the US is, or not say anti-technology, but definitely it's not encouraging the top technology companies to remain merit based. And the top technology companies are seeing the post COVID productivity loss that is going to sustain. So the hope that we have that this technology will be the deflationary with a lower productivity is going to take longer time to get there. So overall, I don't see a way out where we can meet this curve, meet this line very soon, or even if we give up this line and find a new line, even in that case, unless we really raise the rate so high that we can cause some more serious recession, which is actually a very big problem in the next election year. How we can really carve anything. And if a recession happens, remember that we have a huge $31 trillion debt. So the only way to get out of it, of the recession, is to reduce interest rate, and to cause, to borrow more money. And now China is in a driver's seat because they might not be willing to buy the US bonds, given the situation they're in right now. In fact, they could sell US bond, and that raise the interest rate even higher. So Fed will be unsuccessful to most likely to change the monetary policy, and be successful like the last few times. Obviously, they can print money and they can raise more. They can do all this kind of financial engineering, but at the end of the day, it's all connected world, because the dollar is the main reserve currency. If you keep doing that, something is going to fall, something is going to break in the financial system. And obviously, as dollar gets devalued with more dollar available from the Fed, that means that already a challenging situation where we have India is doing their own business with rupees and the rupiah with Russia. China is doing the same. The crypto is in the case, is in kind of like a threat for the US dollar, especially for the third world, for the Africa and other countries. So there is a high possibility that US dollar will not remain the reserve currency of the world. People will kind of revolt. The other countries may revolt. They say we're not going to be honoring that. And that will totally break down the US influence around the world. And that is going to cause the US bond price to go lower, because everybody will sell it, because the rate will go even higher. So there is a possibility that we can see very similar scenario as in US 10-year here. It's unthinkable right now to see the 15% US 10-year, but it might happen because US 10-year we consider as a junk bond, right? If that happens, close to junk bond. And similar thing can happen with the unemployment rate and Fed fund. It's unthinkable right now, but it can go there. There might not be any other option, because if people start selling bonds, then the bond price has to go up, or the dollar has to fall. It could be basically a elastic that is going to cause these things to unwind. So if you look at this, it doesn't look really, there's no respite. There is no way you can go somewhere and, hide your money and you'll be safe. I don't think that's an option. So what is the respite here? It is, I think, the only way to get out of it for US. And if I'm actually the US senator and I know everything, and I'm the US president, and my people tell me that this is the future, the only way to get out of it, go head on with China, who is our, like US's main sort of successor here, and defeat them in the field and reinstate your position, because status quo is bad for US. Or if you wait for too long, then China is going to snatch it. So that's why US is trying to instigate China over and over again to make sure that they regain some of this control back. And if China actually gets provoked and start a war, right now US is in the better position to win this war, and that will end this whole story. So US will do everything they can to provoke in the next few years China and others to instigate this, this World War III. And without it, there is no way out for US from here with this much death. Now, whether COVID was a manifestation of this kind of, whether we'll know in hindsight 20, 30, 40 years from now, that it was all sort of, planned scenario to kind of doom US, we don't know. But certainly it seems that the escalation that happened in the last couple of years, or at least in the last year or so, even the Biden administration did that, followed up, and even stringent compared to Trump administration. Definitely they have news that we will know later on that why they're doing this. So overall, I think that's the video. It's pretty long, but that's my viewpoint, and hopefully that helped.